Carl Goldman with you here on this beautiful Thursday here in Santa Clarita, AM 1220 KHTS. We're going to be doing a special broadcast over the next hour talking about what many people don't realize may be happening, actually is happening, but may be happening to many more people than we realize at this point, and that's the mortgage crisis. We're calling it the second mortgage crisis because it's impacting mortgages out there, and as we've learned with a number of residents here in Santa Clarita who are in jeopardy of losing their houses, we've learned that this is really a fallout from the original mortgage crisis that took place now some 8-9 years ago. We have in the studio with us Richard Sherman, who's a realty specialist, our mortgage specialist. Yep. Lou Esbin, an attorney who we've known for many years, who's a bankruptcy attorney and is now becoming a specialist in this area as well. And of course, our own KHTS, Melissa Lampert, is here, who's our features director. And Melissa's been writing a number of stories. In fact, Melissa, you knew nothing about this starting out, right?
I didn't know.
And then we hooked you up with doing some stories with Richard and discovered some amazing things with the first time. Tell us what happened.
Yeah, so the first time that I met Richard for our feature story that we were doing, it was actually for a family that's living in Saugus, and basically they were facing foreclosure due to some alleged very unfair misconduct by these servicers, these banks, or these non-banks, as Richard calls them, and just finding out the way that the system works and what they're allowed to get away with. It's crazy, and people are losing their houses because of it. Their homes that, the Yu family in Saugus, they had lived there, I think, for 12, 13 years, something like that. They're a family of 5. They have 3 children, and they didn't know, when they were going to have their last day in that house. They didn't know people were going to be knocking on their door and saying, you have to get out today. And then the homeowner, Steve Yu, he actually had a stroke from the stress. It's crazy to me what's going on. I had no idea.
So let's peel this back for a second. Rich, let's use that family and sure, maybe use that as the symbol of what happened. Take us through their process and what the challenges were.
Well, the common misconception is that the mortgage crisis that started in, I'd say, 2006, was really recognized in 2008, is somehow over. And that's just ridiculous. And what happened in the case of the U's and with a lot of other people that we were lucky enough to represent, what winds up happening is the banks feel they can get away with just about anything. They'd been getting a little bit better, but then this year they've gotten much, much, much worse. And because the equity position for most of these properties has come up over the last several years, we're not quite at 2006 levels yet, although some reports will tell you that we are, but we're close. And so what you're seeing is the banks have this attitude that, well, now there's equity in the property, so why should we deal when we can just take the house? And what a lot of people don't understand is that the rules really don't favor the homeowner. And if you don't know what the rules are at all, then you are in all kinds of trouble. And in the use case, what had happened is the particular bank, well, their bank had sold their mortgage over and over and over again to a servicer, finally, like their third-tier servicers. We call them non-banks because they didn't do the loan. And what happens is these guys buy these debts at ridiculously discounted prices, often because the initial bank has charged it off, depending on the type of debt. And then the family that has this doesn't even know, in some cases, who they're supposed to pay, let alone how they communicate with them. And in the use case, they were absolutely candidates for a loan modification. And we fought and fought and fought and fought and finally got one granted through one bank. And then right as that happened, that bank sold the loan, and I shouldn't say bank, I should say non-bank or servicer. That servicer sold the loan to yet another servicer just before the loan modification had been granted. And that servicer said, we don't know anything about a loan modification, terribly sorry. And the law on the subject is clear. If Bank A offers you a deal and then sells that loan to Bank B has to honor that deal. And luckily there was enough of this in writing, and we had enough in our notes certainly, that the final servicer, this company ShellPoint that has it now, wasn't really able to back out of that, although they sure tried. They certainly tried because they did an analysis. They realized there is some equity in the property. And so why should they do a modification? Why should they lower the amount that they're getting when they can just foreclose on the house and make a nice little payday? And so what they did was incredibly underhanded and unbelievably wrong. It's amazing how many times they quote unquote lost the paperwork and blamed the homeowner and all this other stuff. And yeah, as a result of it, Mr. Yu actually had a stroke. It was ridiculous, and he was a mid-30s healthy sort of guy. So it was the stress of this, and it's a hell of a thing to not know if you're going to be in your home next week or next month, especially when you got a family.
Yeah, and we're talking about a Santa Clarita family.
Yeah, absolutely. And we're seeing more and more of this. So the idea that the mortgage crisis of 2008 or 2006, as I call it, has subsided. Yeah, it's gotten a little bit better because housing values have gone up. But as far as the overall crisis, it's not over. And right now we're starting to face the second wave of that, which are these servicers, these bottom feeders who've wound up with mortgages that they didn't originate. And with the second mortgages that a lot of people thought were charged off because they got a letter that said charged off, and they don't understand that charge off does not mean has gone away. They're zombies is an accurate thing to call them because they return from the dead and eat your brain. So between those two things, between the first being transferred to really dishonest, there's no other way to put it. We've dealt with many of these companies, and some are better, some are worse, but it's perfectly reasonable, I think, to call them dishonest at this point because they're simply collection companies. That is what they're there for. And they behave in very foolish ways in some cases because they have this dogma that they create, and they're just going to stick to it regardless of the facts of the individual case. So they're even harder to deal with than the bigger banks that originate these loans to begin with. So between that and the seconds that say they're charged off that really aren't, I mean, they charged off as a term, it doesn't mean they've gone away. You wind up with families who think they're finally coming out of the economic downturn and they're finally starting to see a light at the end of the tunnel. And then what they discover is, well, yeah, that light is the head of an oncoming train. And that they were actually in more danger now than they were before. And we see this over and over and over again.
Lou, from your perspective, this is broader than just one or two families in Santa Clarita and one or two loans, right?
It is, and I've been a contributing author on a treatise on California mortgage and deeds of trust for about the last 10 years. So I'm kind of steeped in it. There are a number of issues that come up. First of all, people have to understand that this whole thing arose when back in the, I guess, mid-'80s or so when banks were failing, the government created a system by which the banks would take loans off the books. So let's have some history to it. They take the loans off the books and they put them, and then the regulators would sell them. Well, Wall Street figured out, now that's a pretty good way of making a lot of money. Mm-hmm. So because the banks did not want to hold bad debt on their books because they'd have to reserve against it, they created a system, came out of Wall Street, of putting these loans into pooling trusts. And that way the loans came off the bank's books, they didn't have to reserve against them, it didn't affect their bottom line, and they could continue on their way. What's happened is that these pooling trusts, they don't sell the loans themselves, they sell pieces of the loans. And so when it's time to try to negotiate with them, you often don't know who you're dealing with. And Rich and I have been doing this for a long time already. What happened is that people get a charge-off letter, or they'll get the IRS form saying the loan has been charged off. And the vast amount of the American public believes that means they don't owe the debt, okay? And that's not true. What it is a charge-off is a step along the way for the holder of the debt to take a tax benefit from the debt not being collectible. But that's not understood by the homeowner. It's not understood by a lot of accountants.
So is that charge-off usually happening on second mortgages, or are they on the first prime mortgage?
The first does not charge it off because in California, well, California is what we call an anti-deficiency state, so that the only recourse that the first has is to foreclose the property. It's called the security first rule. I litigated this issue years ago in an appeal with some of the foremost authorities on this, and they don't charge off the first because they always have the collateral to collect against. But the seconds, to the extent that the collateral, the real property, the home, is not worth what is owing on the property to the first, they will charge it off as being uncollectible. And this is really a tax issue. You can talk to some of the CPAs in town, but they're really supposed to make an effort to collect, and a lot of times they don't. And they just send the homeowner a 1099, and the accountant gets it and goes, "Oh my God, you now have to pay taxes on this for a given debt." And of course, the accountants don't go through the motions of saying, "But you're insolvent," so that because insolvency is the exception to the debt forgiveness rule. And so basically, they stop paying on the seconds because they I don't know it. Okay, but the second rides through and is always secured by the house. Okay, then what happened during the meltdown is people being told, "Oh, don't worry about the second. You don't have to pay it. They'll never they'll never collect it. There were a lot of lawyers out there who were, I'll loosely say, practicing bankruptcy. There's only 142 of us in the state who are certified specialists as bankruptcy. I'm one of them. And they were saying, yeah, I'll file a Chapter 7 for you, and you'll save your home, and don't worry about the second. But here we are, fast forward 8-9 years later, they're still in their home, they're paying on the first, and the second goes, hi, I'm back. And he refers to them as zombie seconds. And they have every right to collect.
And so just let me clarify this for all of us. So someone 8-9 years ago or 10, 11 years ago went and got a second on their home. They got a line of credit. They bought whatever they did with that money, and that second could be sitting there. So here in Santa Clarita, if you had a $500,000 or $600,000 house back then, you might have had a second of $150,000. That was then the meltdown came. No longer any equity, and that home now is down to $500,000. That $150,000 second was then sold off because the banks wrote that off as a bad debt.
Yeah, you have to realize the terminology is that the second is wholly unsecured as a matter of law. Okay, that's actually the terminology. Okay.
But I'm trying to do this in Carl terms so I can understand it.
I'm
sorry. Yeah, that's all right.
Well, also before you continue, you should also consider a lot of these loans that were done between, say, 2005 and 2009 were what they call 80-20 splits. So you had an 80% first and a 10% or 20% rather, in this case, second.
On the purchase.
On a purchase. So it's actually purchase money. It's not they didn't use it to go on vacation or buy motorcycles. They used it to buy the house, but it's still a second. And lenders like that because if the property devalues, that second takes the hit before the first because it's in second position.
Yeah, but then there's a series of cases that deal with it. So it used to be that the banks would hold on to the first and the second.
Yeah.
And when they foreclosed, they had to foreclose on the second and not the first. But then what happened is that they split them. And so they would sell the first over here and they'd sell the second over there, and no longer was that duty to foreclose on the second first. And there's actually case law that dealt with that, where someone argued, well, wait a second, it was an 80-20 split, it was a purchase money, and the California Court of Appeals said, no, sorry, that first is owned by one entity and the second is owned by the second entity, and that obligation no longer exists. And that's kind of how we get teed up to where we are today.
Got it. So I'm going to finish with my understanding of it. It's AM 1220 KHTS. Carl Goldman with you here. We're talking about the we're calling it the second mortgage crisis with realty specialist Richard Zerman and Lou Espen. Melissa Lampert with KHTS Features is over here as well. And so going back to this home analogy we're doing, that $150,000 second, which may have been used to purchase the original home,
or a
that
HELOC.
That got sold off to a different loan company at
Correct.
pennies on the dollar because the bank the bank had already written it off and gotten their tax break on it.
Correct.
It now got picked up by these smaller companies, collection companies, as you call it, Rich, or
Vulture
whatever.
capitalists.
Yeah.
And I understand. I did some Google on this and found that a lot of the folks inside the bank, the actual executives in the bank, also seem to be on the boards of some of these others.
We'll come
back. We're going to come back to that in a few minutes. But before we get into that, I just want to clarify. So now that money, that loan, that note, which that's new company bought at pennies on the dollar, so that $150,000 they may have bought for $1,500. There you go. So so $1,500. Quite a deal, but so at $1,500, that investment they could sit and wait, which is what they did.
Right.
So they sat and just did nothing over the last 8, 9, 10 years, waiting for the real estate market to recover.
And all the interest accrues.
That's what I was going to add. I think Rich, on your last appearance, was that not only does it come back, it comes back with 10 years of interest.
Well,
accrued.
it's interest and late fees and penalties and everything accumulates because the terms of the note are enforceable.
Yeah. Well, and that's really the dirtiest trick out of all of this, because what happens is the bank charges it off. They take the write-off in whatever form that takes, and then so they say this is worth nothing. So they take the charge off, they take the loss, then they sell it for something, and then that company sells it and sells it and sells it, and finally get down to a company who just says, well, now, even though we only bought this for next to nothing, your $150,000 debt, say if it's at 10% interest, which would be pretty normal for a second, over the course of about 10 years, you're now looking at a $500,000 debt, a $400,000, it's an outrageous number that they can just sit on. And the reaction to these things is horrible. And what really makes it irresponsible from their point of view is that they pay very little for these loans, and they just create sort of a rule, like this is how we work. And they create a sort of a dogma, and this is sort of it.
It's a business model.
Yeah, exact. Business models, actually, that's the nice way to put it, I suppose. And then what happens is they stick to that business model regardless of how stupid it is. We've got one, this is an excellent example. We've got one, Lou and I, right now, where the family owes slightly more on the first than the house is worth. And I'll let Lou explain why that's important, but that's very, very important. We go to the second, and we say, look, we'll give you, this is ridiculous, it's a $60,000 loan. Now it's a $130,000 loan. That's insane. But I tell you what, we'll give you 20 grand up front, and my client will start making payments, give him an opportunity to get caught up. The bank comes back and says, nope, we want $78,000 up front, and you can start making payments of $1,400 a month for the next 15 years, which is ridiculous. I mean, it's beyond the pale. No bank that does that is serious about working out a deal. I don't know if they thought the house was worth more money or what, but we went back to that second and said, look, here's an appraisal. In fact, here are two that show that the house is already over encumbered by the first. Their attorney actually called us back and said, well, I understand they're going to file a Chapter 13 because that's really what they have to do. And I've explained to the board of directors at this bank, Trojan Capital, by the way, a little plug for them, or anti-plug for them. Anyway, I've explained to them that this is a bad idea and that they're going to lose everything on this loan and they should work this out with you. And they told us, nah, never mind. Okay, so you're forcing this family into bankruptcy for really no reason. The bank involved isn't getting penny one out of it. The family's now going to shred their credit after spending 10 years trying to dig themselves out of this hole. And the bankruptcy court gets yet another case that it doesn't need. All because of just greed, stupidity, and a business model that is inherently corrupt. Because they collect on such a low percentage of these loans, but they buy them so cheaply that it just doesn't matter. And when they collect the full face value of that loan, it's not like the bank that sold it off and charged it off and took the benefits of the charge off and all the rest of that stuff ever has to report anything. They're just done. It's off their books. They're good to go.
And what happens is that because the bank that took the charge off, let's say sells it for $1,500, so that $1,500 then just goes to capital. It's income to the bank that sold it. So when the vulture capitalist then collects, let's say, $300,000, that doesn't go to the cap. That doesn't go to the bottom line of the bank that sold it. That goes to the vulture capitalist, that's their business model. And the interesting name of this company is Trojan, like a Trojan horse. They all of a sudden show up at your doorstep and say, "Hi, we're going to take your house."
Yeah. But if it goes in, I'm missing one step here. So taking that example, it goes into bankruptcy. If I'm correct, the homeowners in bankruptcy get to protect their home.
Yeah. So what happens is that there's an automatic. I'm sorry.
Yeah.
There's an automatic stay that takes effect as foreclosure proceedings
Right.
stop. Because the house is worth less than the amount owing on the first, it means that the second is, I used this term before, and there's a reason for it, wholly unsecured.
Right.
So because the second is wholly unsecured as a matter of law, in the bankruptcy case, that second, ultimately, when homeowners receive their discharge, will be stripped. Okay? So at the end of 5 years, homeowners exit bankruptcy, Chapter 13, they get their discharge, and that second is no longer their personal obligation, but likewise, the second is removed from title. But it's a 5-year process.
So over the 5 years, the second disappears. The folks who were carrying the second only get the same percentage of revenue out of that whatever that bankruptcy
Right.
Assets that remain are there and takes off. This is disheartening and fascinating. We're going to find out more right after this short break. AM 1220 KHTS.